Okay, I started the recording. I want to let everyone know this is my disclaimer that we are recording this and we're live on Facebook. We record it for training and quality assurance and content purposes. So I'll drop that in the chat too. Just be aware that this Zoom meeting is being recorded.
All right, so in the meantime, let's give it 3 more seconds. I'm gonna put here the title for today's training. All right, so there it is. I put it in the chat. So today's training, I wanted to talk to you 2-3 minutes, not too long. Basically, it's 5 facts to attract home sellers in 2020. So I think this is very relevant to what we're going through nowadays. And we're gonna go a little deeper into the financing and the mortgage aspect of it. So we're gonna kind of like connect the dots between sellers and buyers, and how can we benefit if we implement both of them today in our business. So as you know, to say that the year 2020 is an unusual one is an understatement. But unlike many housing analysts predicted, the housing market remains strong, and experts now believe a crash is highly unlikely. So there are many reasons for sellers to toss their hats into the home selling ring in 2020, and you can use them to your advantage. When you come across a potential lead who is on the fence about selling in the current climate, you gotta lean on market data and trends to show them why right now it's actually a great time to do it, now more than ever. So I'm gonna give you 5 facts to entice home sellers for this year, 2020. So let's start with number 1. Home prices are on the rise. Fueled by low inventory and increasing buyer demand, home prices have slowly increased over the last few months, and I'm pretty sure you have noticed that. And that trend is expected to continue. The National Association of Realtors chief economist, Lawrence Young, believes that home prices will climb to 4% growth overall in 2020. So what does that mean? Well, that means that it's a great time for sellers to capitalize on the equity they have built in their homes. But because many buyers might be priced out of the market, if prices continue to climb, it's very important for sellers to make their homes stand out from the competition and rely on high quality photos and virtual tours to pre-sell homes or pre-sell on their homes. Most sellers will also be able to hold out for higher price offers if they aren't thrilled with the initial offers they're receiving. So keep that in mind. Number 2, interest rates are at historic lows. And we're gonna go a little bit deeper on this, and I have a guest speaker with us today. But last week, average US mortgage rate for a 30-year fixed mortgage fell to an all-time low of 2.88% according to Freddie Mac. And Julio is going to be talking a little bit on that. But of course, these low rates are a major draw for potential buyers looking to find their next or first homes. But these low interest rates also spell good news for home sellers. As interest rates continue to fall, more and more buyers will enter the market, resulting in increased home demand and higher sale prices. And that leads me to number 3. Inventory remains low. Now, while low inventory means more competition for buyers, it also means sellers gain the upper hand in most transactions. Homeowners who choose to sell can benefit from this increased competition. For the 3rd consecutive month, Redfin, for example, reported that more than half of its homes had multiple offers. You guys have mentioned before how you present an offer, and when you present an offer, there's multiple offers already on the table. So you are experiencing this firsthand. The data found that 56% of single-family homes had multiple offers, followed by 54% of townhomes and 42% condos. This increased competition for houses means higher prices and potential bidding wars. and all of you are experiencing that right now. Number 4, home equity is unlikely to drop. With most housing markets at low risk for a downturn, the 2020 Housing and Mortgage Market Review estimates home prices will continue to rise for the next couple of years. Again, what does that mean? That means that homeowners just starting to think about selling will likely benefit from increased prices for the foreseeable future. You can persuade potential leads to enter the market by offering them a free home value estimate. That's a great tool that you have in your hand. And the last fact that I have for you, number 5, is virtual showing tools means less people physically walking through homes. By now, all of you guys have perfected the art of showing homes during the pandemic. In addition to thoroughly sanitizing their properties and mandating mask wearing during showings, you guys as real estate agents have increasingly been using video tours and virtual tools to give buyers more realistic picture of the homes that you list online. These tools act as a weeding out tool so that the buyers who do schedule in-person showings are likely more serious and pre-sold on buying the homes that they tour. Even the most anxious homeowners, they can be convinced that now is a great time to sell if you take the proper precautions and put together a strategic virtual marketing plan to sell their homes with the least amount of foot traffic. So again, you guys are taking advantage of a great deal of opportunities out there, and we want you to continue taking advantage of that. And this fact, it just shows that we're in a very strong market right now, putting aside the whole pandemic and the whole issue that we're facing. But let's go back to number 2 for a moment, and let's dig in a little deeper on the financing and the mortgage option. And for that, I have invited my good friend, Julio Noe, who's here with us today. He's with City First Mortgage. How are you, Julio?
I'm doing well, Dan. How are you?
Good, man, good. I'm so happy to have you joining us for this training today. Julio, talk a little bit about yourself, the company, and what you guys have to offer.
Sure, absolutely. Thank you, Dailang. Is it okay if I share a presentation? Can I share my screen for a moment?
Steve is going to help you with that.
Yep,
yeah,
I'm giving you permissions right now, Julio.
Let me know when I'm good to go, Steve.
Okay, go ahead. Try it now. You should be good.
All right, stand by for one moment. Let me know if you guys can see my
Yep.
screen.
Yeah, I can see it.
All right. So thanks, Dailang. I appreciate the time and the platform. Steve, thank you for allowing me to come on here with Dailang and really talk a little bit about myself and where I came from. Some of the value that I can try to bring to the table for you and your entire team. A little bit about me first, right? So I'm a Florida native, South Florida native, been here my entire life. I originally started my mortgage career in 2006. I was VP of residential lending for First Financial Mortgage in South Florida. In between then and now, I spent many years in communications. So I do have corporate America experience. I think some of the biggest value that I got out of that time frame was the ability to maneuver through processes and really understand some of the red tape and the obstacles that are thrown at you on a daily basis. So I absolutely get it. I recently joined City First Mortgage with Carlos Lastres. So some of you guys might know Carlos, a very close friend of mine. I've known him for 20 years. A little more about myself. I'm married, 25 years married. I have 2 kids. My son just graduated from Belen Jesuit, and my daughter's a junior in high school. So as I'm looking, on how our relationships can grow, right, and what I bring to the table, I ask myself, man, you guys probably come across a ton of mortgage loan originators, right? So MLOs probably knock on your door every day, right? So how can I differentiate myself? What is the differentiating factor besides what the company brings to the table, right? Me personally, right? There's 2 things that come to mind, right? So accountability and accessibility. Those 2 things are vital, right? Being in the business for so long and working in corporate America for as long as I did, I got to tell you that accountability is huge, right? It's the ability to rely on your business partner to make sure that we are working together to reach a common goal. Accessibility is the other accessibility is a major issue, right? Because I hear all the time agents having issues with either they're just inner working, right, working out through their internal process and not being able to access or reach out to those that are supposedly working together for a common goal ultimately, right? So I focus on both of those two things. Apart from the value that I try to bring to your clients, I focus on being accountable and I'm an owner, right? So I own the process from beginning to end, and I'm accessible to you and your clients at all times. So last bullet point, right? So I work for both you and your client. I put their best interest first, and then I don't lose sight of the fact that we work together and that I can bring some value in making sure that your files get closed without delay. So I put myself in your shoes. I know how important it is to ensure that there's no outside factor delaying the process. Your jobs are hard enough as it is. So I take ownership of what we do and make sure we do it right. So a couple of things that I want to go over. I'm gonna spend a little bit of time going over some of our products and programs, QM and non-QM programs. For those of you who don't know, right, QM is qualified mortgage. Your traditional conforming, Fannie Mae, Freddie Mac, conventional VA, FHA, those kind of things. And then non-QM programs are everything that kind of falls outside the box. They become a little more lax recently, so that's kind of a big deal. And when I say recently, I mean over the course of the last 10 years. So I want to kind of cover both of them, because I want to make sure that as you have these conversations with your clients, you can keep in the back of your head, well, look, there's possibly a solution for every scenario, right? And then I make myself available at any time to ensure that if you have a client that you need to kind of go through in detail, because it's very hard to do that now in this presentation, right? There's a lot of details and nuances that make qualifying or determining whether a client qualifies or not kind of more complicated. It might be a little overwhelming at times, right? So, and I'll say it again at the end of the presentation, I'm accessible to you at any time if you just want to have a conversation or discussion virtually or in person to determine if your client fits one of these following buckets that I'm going to go through now, okay? So let's start off with your standard FHA program. Everybody knows FHA, you've all heard of FHA programs. I want to point out the biggest advantage from an FHA program is obviously more flexible underwriting qualifications. It's generally speaking for the less than perfect credit score borrower, right? Now there are caps, so there's loan amounts capped at 373, 750. Please keep in mind that that's capped in loan amount, not purchase price. So I've had interactions recently with several agents that tell me, oh, the property costs 450, I can't qualify for FHA. Well, no, the program states that the loan amount has to be 373, 750 or below. Anything above it, you can buy a $500,000 property as long as the difference is utilized as a down payment, right? So I mentioned a moment ago that they have more lax or easier for borrowers that don't have perfect credit scores. Well, prior to this pandemic, we were in the high 500s. So, we can get an FHA borrower approved at 580, 590 all day long. Now they've become a little more strict. It's still very tempting at 620, but we believe that's temporary. I think that when this craziness is over and we kind of go down a road where we return to some sort of normalcy, I think we should be able to qualify borrowers at the upper 500 credit score. But again, another advantage is the fact that you have a low down payment, right? High LTVs. So it's a good blanket for borrowers that maybe fall in one of these buckets. Again, keep in mind that every borrower is different. So as you're talking to your clients and you're trying to identify what the best course of action is from a financing perspective, let me know. Let's talk about it. I'll share with you my opinion, my insight, and then that way it'll make your job a little bit easier. Again, it's all about making your job easier. I know your job's hard enough. Conventional programs are the ones that we do all the time, every day, right? So the credit criteria here starts about 620 to 640. Keep in mind, there's always circumstances that can adjust that, right? Max loan amounts all the way up to 510, 400. Now, keep in mind, for it to be conforming, it can't go beyond 510, 400, but that's for a single family home. That doesn't necessarily apply for a multi-unit property. So you can apply a conventional conforming product for 2 to 4 unit properties. And the max loan amount slightly increases, right? So I'll give you an example. A single family home is 510, 400. 2 units is 653, 550. And you can do a triplex at 789, 950, or you can do a 4-unit property at 981, 700. So again, I'm not expecting you guys to remember those numbers off the top of your head. That's my job. But keep in mind that the thresholds are a little bit higher if it's a multi-unit property. Occupancy, obviously, It could be primary, second home, vacation property. That's not an issue. One of the biggest qualifying factors is the DTI, right? It's debt to income ratio. A lot of things have influence over, how a borrower ultimately gets qualified, but DTI is a big one. So on paper, obviously, you don't want to exceed 43%. I just did one this morning where strong borrower, great assets, good scores, and their DTI was about 48, almost 49%, and DU approved it. Again, for those of you who don't know, the debt to income ratio is the comparison between what a borrower makes and what they spend, right? So they come in X amount of dollars, more than 43 to 48% of that income can be used for covering their expense, right? For housing expense. So again, the conventional program is very strong. It's something that most borrowers nowadays are falling into, but again, this is all standard stuff. It's the outside of the box solutions that really kind of grab people's attention. VA programs are there. If you have a borrower that is a reservist or even active duty personnel, spouses of veterans, it's all based on the military entitlement. Some of the benefits for VA program for our veterans is no down payment, very high LTVs. In many cases, I saw one recently at 100% financing. The biggest takeaway is no mortgage insurance. So there's no MI. Remember, anything over 80% loan to value usually triggers MI. In this particular case, VA programs don't have MI. There is a funding fee, and we can talk about that in more detail, but more often than not, the benefits kind of outweigh the funding fee. But again, we can go through every single scenario to really understand if this is a true solution for your borrower, right? So now let's get a little bit about going into non-QM. Jumbo loans are there, anywhere between conforming at 510, 400, all the way up anywhere between $3 and $5 million. It could be fixed or adjustable. Either one will work. Single family or townhouse PUDs, no problem there. Keep in mind that jumbos, with our investors is 20% down, generally speaking. A little further down in this presentation, I'm gonna talk about two things, but one of which is really interesting, which is a simultaneous HELOC, piggyback second. And for borrowers that if you have a client that's kind of just fell into the jumbo window, right, just above, the loan amount's gonna be above 510, 400, we have a solution where we can piggyback a HELOC second, bring that first mortgage down within the conforming guidelines, and then they can have a HELOC that they can utilize and kind of keep that down payment to a minimum. That'll qualify at 90% loan to value. You only need 10% down in that solution as opposed to 20 here. Again, I know it's a lot of information I'm throwing at you, but keep in mind, jumbo standalone, 20% down, generally speaking. But if they're just falling into the jumbo window, let me know. Let's talk about other solutions where we can come in at only 10% down and then do a first and second, but I'll touch upon that in a minute. Foreign national programs. Well, I giggle because back in 06, 07, 08, we did a ton of foreign national. The criteria was much different back then than it is today. Now we're looking at 70% max loan to value, loan up to 5 million. Again, one thing to keep in mind, if there's a little bit of a challenge with residents in Venezuela. Apart from Venezuela, it seems to be working okay. Again, we'll talk about some of the details and qualifying factors when you come across a client that needs to kind of dive into this. If you have a foreign national that wants to invest and make a purchase through you guys. So again, we do have that program, and we do have the investors to carry it. This is one of the great programs I wanted to talk about. The other day I was talking to Dalan, and he asked me, keep in mind some of the major differences, right? Some of the things that are making a difference from a financing perspective, right? And this is one of them. Any borrower you have, self-employed or 1099, that has a hard time showing income, we can use this bank statement program. Again, 90% LTV is max, right? So come in with 10%, and you want a 700 plus credit score. But think about this: you can use either personal bank statements or business bank statements, and there's a calculation on the screen. If we look at personal bank statements, either 12 or 24 month review, we can do 100% of deposits. So there's the example on the fifth bullet point. 24 months deposits. Let's say in 2 years they've deposited $200,000 in their personal bank statement, which is divided by 24, and use $8,333 as qualifying income, which is super strong, right? There's nothing else we need to show from an income perspective. We can do the same thing on business bank statements. On the business bank statements, we use 50% of the deposits. Obviously, there's operating expense and some overhead that we need to account for, so we'll use 50% second to the last bullet point, it gives you that example, right? $500,000 in deposits, divide by 2, right? 50% of it is 250, divide that by 24. We can use qualifying income at 10,333. Very strong program for self-employed or 1099 borrowers. Again, this comes across your desk. Let's work together to see if this is a fit. But in many cases, this is a very, very strong program that we have available. This is the other one. This is the one that I mentioned a moment ago, the simultaneous piggyback HELOC. This is fantastic, right? So minimum credit score is about 700. Minimum line is 50,000. And the max LTV is 90. So let me just break that down and kind of explain what that means. I'll use a brief scenario. When you have a customer and they need a condo limited review, this will qualify, right? So if you have a customer that's buying a $200,000 condo, I am pretty certain that a lot of you on this call have come across issues where the units aren't warrantable. They're not FHA approved units. They're not, the financials in the condominium are poor. They don't have the 10% reserves in line. And a borrower has to come in with 25% to make the deal happen. So we can kind of put this, call it a loophole if you like, right? We can do this and do a simultaneous second. So on a $200,000 purchase, come in with 10%, it's 180, okay? So the 180 that we're financing, we'll break it up into 2 loans. The HELOC second minimum is 50, right? So we'll do a 50,000 credit line on the second, and we'll do 130 on the first. Well, that 130 represents 65% loan to value. Now we've circumvented, for the lack of a better term, the fact that we have to make that unit warrantable and kind of gather the financials, ensure that the reserves are in place. Hence, condo limited review is the title of the slide, right? So that is a great program. Keep this in mind. We can make things happen with this program, specifically when you have borrowers that are trying to buy in a condo and they don't have the strong financials that Fannie Mae, Freddie Mac requires to sell their loans in the secondary market. This is a big one. I also mentioned a moment ago in the jumbo, right? If you just fall into that jumbo window, I mean, although the max line is 500,000, I believe the max exposure is 1.5 million, if I'm not mistaken. But I can do the line at 500. I do that all day long, right? So if you have a loan amount of 650, 700, we can bring that first down into conforming guidelines and do the second in this piggyback HELOC. It'll close simultaneously. And it really works out. It avoids the customer coming in with a 20% on the jumbo criteria, and we can do it at 10% with this combined LTV of 90. Again, I know I'm throwing a lot at you, but this is information that I just want you to keep the premise, the idea in the back of your head, because you'd be surprised how many folks I talk to that are not aware of this, and they struggle. I have a situation now where I had a young lady, mid-20s, trying to buy a condo. She's been looking for months. And everywhere she's gone, it's, they haven't been able to do it because none of the condos she's looking at are able to Fannie Mae, Freddie Mac won't finance them through those conventional guidelines because we can't make that unit warrantable. And when she landed on my desk, we had a long conversation, and the agent went ahead and made the offer, and then we're going to be using this program. So it's going to be fantastic. Investor program. There's any investors that land on your desk, we have a program for them. Now, the key here is to keep in mind that the investor is basically based on the cash flow of the property. So, there's no income, no tax returns. The property has to make sense. I think there's a minimum credit requirement, obviously, but for the most part, it's all based on the cash flow of the property. So if it makes financial sense, as we put it through an internal formula, and we know we can do it, again, single family condo, 1 through 4 unit, we can do those all day long. Again, if you have a scenario of any of these scenarios that we need to discuss, please call me and let's discuss them in detail. But we could spend hours going through this. If I don't have the answer, I'll find it for you. You have my commitment on that for sure. Okay. So, let me just wrap up by saying that there's a lot of investors that work with us. We have a lot of programs that we can be very creative. We have the tools internally to put together the deals for you in a manner in which really bring value and a solution to your client. I know Leon well, and I understand the importance of making sure that that you maintain your clients and your customers happy, that you're doing the right thing to ensure that you're working for them, right? I know that you guys put a lot of resources and money and time into gathering your leads, building your pipeline, and when you have that client, you really want to do the right thing by them, right? Keep in mind, it's very clear to me that that your process could be complicated, but at the same time, I'm here to try to make that easier for you. So I built great relationships with real estate agents. I make great relationships with clients. I have a lot of referral business, and I can tell you that I try to bring as much value as possible. At the end of the day, I grow my business through the referrals, and if I don't do my job right, I got to tell you, it's bad news for me, right? So I take it very, very seriously, and ultimately, I'm here to make sure that you guys know that I take your job seriously as well. So again, we have the resources, we have the personnel, we have the process in place, completely automated, completely touchless if need be. If they want the personal interaction, we do that as well. But I'm here to make sure your file's closed and offer as many options and solutions for your clients as possible. So Delan, I'll kick it back to you. Thank you again for your time. I'm going to send you this presentation in PDF so you can distribute it if you feel that's appropriate. But again, thank you again for your time, and please keep me in mind, guys. All my numbers there, and I'm here to help you in any way I can.
Julio, we have a couple of questions that we can throw at you, if you will.
Okay, I can try to answer them.
Okay, from the chat, we have a question. What if they don't have a 620 FICO score because of the issue with COVID?
Yeah, so that's a challenge, right? That's a great question, actually. We had a situation, it wasn't a purchase, it was a refi, but the client's house was in forbearance due to COVID. That's generally not a good situation to be in. We did one about 3 weeks ago where the client had to come out of forbearance. It was affecting his credit score, but he came out of forbearance in order to do the refi. If the scores, to your question, Steve, are below 620, generally speaking, it could cause a challenge, right? There has to be other influencing factors in order for us to take it into account, run it through DU, and see if we can get an approved eligible. But for the most part, if they don't meet that credit requirement through QM, we'll have to look for a non-QM product, possibly an FHA solution if their scores are under 620.
Okay, then we have a question.
Give me a second. I just wanted to ask real quick because, I mean, I know, Steve, you're going to the second question, but the FHA on the condos, right? The question here is, can you go over FHA with condos, but how is that working out? Do you have a list of the condo, the buildings or the condominiums that are approved that you can send that to as well?
Absolutely, Dylan. There's actually currently only 6 condos of FHA approved in Dade County. I have the list and I'll send it to you so you can distribute it to your team. No problem.
Okay, perfect. So how is that working right now on the FHA condo?
So those are easy. They're pre-approved and the process is simple. I mean, we can do, the 3.5% on those condos all day long. It's the ones that are not FHA approved that we need to make warrantable, and that's where the challenge comes in. Borrowers have to come in with 25% if the financials are not sound for that condo. So again, the process is a little bit more intense, right? Because we have to approve that unit in order for the financing to be approved. But for the ones that are already FHA approved, it's easy. It's a rubber stamp. It's not a problem.
All right, beautiful. Yeah, send me the list when you get a chance because that will save so much time, rather than just going after the ones. Now, if we go after one that is not approved, is there a process that we can? Because some of them might be they might qualify, but they're not showing up as approved yet.
Right. There is a process for the condominium to actually go through the approval process. That could be time consuming, Delan, and sometimes your borrowers don't have that time and your agents probably don't have that time either. So yeah, there is a process for the condominium to become approved. It's a little lengthy. That's why in cases where they're not approved, if the financials are sound for the condo, we can make that unit warrantable. And by doing so, we need to make sure that the condominium has 10% reserves. The financials are, there's no litigation against the community. There's no, excessive liens or liens against the property. There's some steps that we can take internally. So when we come across that type of scenario, we go through a review process. So there's like a $300 fee that a borrower would pay to get that unit warrantable if the initial review shows that the condominium has sound financials. And then we do that internally. And once we get that unit warrantable, then we can proceed as long as they meet the rest of the guidelines. But for the most part, there is a process in place to not only get the condominium approved, but if that's not an option, we can get that unit approved as well.
All right, perfect. Yeah, so send me a list when you get a chance. And those, you guys that are joining us today, please, if you want to get that list, send us an email to Steve, Steve at brokernation.net, or myself, Dailan, at brokernation.net, or feel free to reach out to Julio, which is joining us today. And we'll send
You'll have that.
to you right away.
You'll have that list today.
All right, beautiful. All right, so there's another question here. It says, with the 10% down HELOC on condo, there is no questionnaire form?
No, that's exactly what I was referring to. So the first is conforming. In my example of $200,000 purchase, 10% down is 180. The first is only going to be 130. So we don't need to gather. That's why it's called limited review on the condo. We don't need to go down that road in order to get that condo questionnaire approved and check the financials and none of that stuff. So we could do a piggyback second simultaneous close on that HELOC. With a CLTV, with a combined loan to value of 90%, showing the first being 130 and the second being the minimum, which is 50,000, totaling 150, which is 90% of 200 in this example.
Great. Yeah, I think that's a big one right there.
Yeah, I think that's I got to tell you, Daylan, I think that is one of the biggest game changers, in my opinion, right? Because I see the struggles that you guys go through. I mean, I get calls, I'm not joking, every day of real estate agents, or more importantly, even clients telling me, man, I found this great condo. I know they're not FHA approved. I'm really interested in buying a unit in this condo. I don't have 25% to come in as a down payment, right? And then what do? You walk away, and you'd be surprised how many clients walk away because they can't buy that unit. They don't have the down payment to avoid that condo review on the financials.
Absolutely, yeah. Okay, one thing I liked, it was a good takeaway. It was the whole investors, the one for the investors, but the question that I see in the chat is, what is the minimum credit score on the investors financing?
It typically is 700, Daylan.
700, okay. All right, let me see.
But again, there's one thing I want you guys to keep in mind. These are the guidelines, right? The criteria. Understand there's always influencing factors, right? So if it's there and it's close, let's at least have a conversation. Let's talk about it to see if there's a way that adjustments can be made, if there's other circumstances that would paint a better picture, right, for the underwriter and for us to process these loans and get them approved. Because yeah, it's easy to say, well, if they don't have 700, just walk away. Obviously don't do that, right? Let's talk about it. Now, if a borrower has a 560, he wants to put investment property with a 10% down, that's going to be a challenge, right? So you guys can make that determination, no problem. But if you're there, or if you're close, let's get the whole picture, right? Let's paint the whole picture to see if there's a bucket that we can put them in to make this work. I'm not saying that it's always going to find the answer, but more often than not, you'll be surprised when we can get a little creative and find a way to, using our programs to our advantage to qualify a borrower, especially if they have, other circumstances that make them more favorable.
All right, great. I have a question here from one of the agents, Jane. She's asking, is your processor and underwriting that in-house, or do you send it out to another office?
Great question. 100% in-house.
Excellent. We love to hear that one, though.
Yeah, we do not use, back in the day, when I first got into the business in 07, 06, we did use outsourced processing. Now, everything is 100% in-house.
All right, great. Jane also asking a question. It says, same 6 condo buildings that have been the only ones approved in Dade County for the last 5 years?
Yep.
All right, so it's the same one. So a lot of you might be familiar with that.
There's actually a link I can send you, Daylan. Public information, obviously. There's a link that actually gives you even the list of condos that have expired that they haven't renewed their approval.
I was going to ask you.
You'll see, yeah, they're there. You can see them. You'll be, be creative, right? When you see one that expired, there's a pretty good chance that, there's a pretty good chance that they just didn't go through the process to get renewed, but they still may be in good standing, right? So they may still be a great candidate for one of your clients to come and buy a unit in that building. The 6 that I'm referring to are currently approved FHA buildings, and that's the list that I'm going to send over to you. But there's plenty that are in good standing and just haven't gone through the process.
That's perfect. Yeah, no, definitely. Another thing that I took away, which when you started off with this presentation, is making a difference, right? And the differentiating factor is accountability and accessibility. So I love the fact that, you know, we need you guys more than ever now to be able to help our customers, and we need to be accountable on our terms, but we need our you know, our team, in this case, you, your company, to have that accountability as well and accessibility. So I love that. So thank you so much for pointing that out.
I'm here for you guys whenever you need me.
All right. So thank you, Julio. Appreciate it. Does any of you guys have any other questions you would like to ask Julio while we have him here with us today? Please feel free to unmute yourself and ask him. Don't hold back. If not,
any questions come up, yeah, if any questions come down the line, obviously, like I said, I'm available to you anytime. You can reach out to me.
I have a question. I have a lender that offers, I have a lender that offers 5%. Do you guys offer that same program?
Sure, that conventional 5%. Yeah, conventional
Okay.
5%. Yep.
Okay, you have it. I just noticed you mentioned the 10%, but you didn't mention anything on 5. So I'm just wondering. Okay. Okay, perfect. Just wanted to know. Thank you.
You got it.
all right. Anyone else? I just posted again in the chat Julio's information. Please feel free to reach out to him if you have any questions, or you think of anything, or you have a case right now that you might be having some issues with, and you want him to look it over. Please feel free to talk to him. Again, his information is in the chat. All right, Julio, thank you so much, man. I really appreciate your time and effort and putting that presentation together and coming to us with so much information.
Got it.
Julio, so next time, let's see if we can put another training together and go a little bit deeper, or maybe on some of the specific topics, or we can do like a case study on a particular issue to see how we can come out of that, or a particular situation, you know, depending on that. So I look forward to having another training with you, man.
Hey, real quick, I have a question too. Julio, what's the maximum DTI for the 5% conventional?
5% conventional on paper should be 43% front end. But again, there's other circumstances that allow a higher DTI. The example I used was I have one on a small borrower that was very strong, and we got DU approval at 48%. I'm sorry, 48% DTI. So, you know, as long as it doesn't exceed 50%, 50% DU usually spits out a no-go. But if it's below 50%, depending on the circumstances, we've been able to push it through.
Okay, thank you.
All right, anyone else? If not, hey guys, thank you so much. Julio, thank you again for joining me today. I really appreciate, again, your time and effort. And this presentation has been great. Steve, what do we have coming up, man, for next week? I mean, you had 2 trainings this week that was fantastic. So what do we have?
Okay, I'm glad you asked. I'm sharing my screen now. Can you guys see my 103 is what we have coming up next week, 103 and 104. On Tuesday and Thursday, we did 102 and 101 and 102 of our 4-part series. And next Tuesday and Thursday is going to be 103 and 104. So on Tuesday, we're going to do my personal favorite, which is lead generation. How to generate leads with Facebook and Google and content marketing. So this is actually the part that I enjoy the most. We did a lot of foundation stuff in the first one. We did a lot of setting up our CRM and setting up our automations in the second one. The third part is where, okay, now what do we got to do to feed the machine, to create some lead magnets, create content, and put it out there in the world so that we get leads coming back. So I'm going to be talking a lot about that, and some of you have already heard it before. I would recommend listening in again, and you might pick up some new stuff because I'll be updating it for COVID and things like that. Then 104 is going to be really wrapping up, putting all these pieces together we've been talking about through the first 3, and automating it to build a pipeline. So the idea that we're trying to do here is to build a pipeline, a consistent pipeline of leads, build that machine that brings a consistent pipeline of steady new business. And we're also going to be talking, I think Armando's going to join us and talk about closing these deals too. Daylon, you might want to join us too and offer some tips and tricks about how to really get it to the closing table and really seal the deal and finalize these these deals that you have in your pipeline.
Excellent, man. I'm looking forward to that training. And those of you that missed the training that Steve had, as you notice, we're going to go to 103. So that means that we have 101 and 102. If you missed any of those, feel free to reach out to us. Send an email to Steve at brokernation.net or myself, Dailan at brokernation.net, and we'll be more than happy to send it to you right away. The same goes with any of the trainings that we've had. This same meeting, the information that, the slideshow, that the presentation that Julio just gave out, any information that we gave out today, feel free, if you want to see the recording, if you want the presentation, reach out to us, reach out to Steve, myself, or Julio directly, and we'll be more than happy to send it to you. All right, guys?
Yeah, and Daylon, is it okay to tell everyone that we're working on building a content vault of putting all these things together and offering it to certainly our agents. Broker Nation agents are going to get full access to everything that we've been doing, all these trainings that we've been putting together. And in the meantime, though, we are doing it by request. So be sure to reach out to me at steve@brokernation.net. I'll put that in the chat too. You can register for the next events, the 103 and 104. You can register for Monday. We have Mindset Monday with Daylon. Register at brokernation.events. Instead of .com, it's .events. Just remember brokernation.events.
All right. All right, guys. So thank you so much for joining us today. That was Real Estate Friday for you. My name is Dailan Rubido. Thank you so much for joining us. I wish everybody a wonderful Friday, an amazing weekend, and please stay safe and stay productive. All right. All right, guys. So with that, I want you everybody to have a good day. Take care. Bye, Julio. Thank you, man.
Thank you. Bye-bye.
Bye, Esther.
Bye-bye. Have a nice one.
You too.
Okay.
Bye, everyone. Have a great weekend.
Thanks, everyone.
See you later, everyone. See you later. Bye.
Bye, everybody.